Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. A victim of its own success, Nvidia delivers a good earnings report, but after 2 years of blowout numbers, investors were looking for more. President Trump says tariffs on EU products will be 25% and include autos, amongst other things. Plus, tariff turmoil dominates the G20 meeting. President Ramaphosa calls on nations to tackle global challenges more decisively. We will be live in Cape Town. Well, it has just gone 8 a.m. across the Emirates. I'm Jumoke Oduwole, back in Dubai after a couple of days off. I was in Abu Dhabi yesterday, though, in the region. But let's get you caught up to speed on markets, because there are two major themes dominating today. One is Nvidia earnings. I thought the numbers are pretty solid, 80%, almost an 80% increase in net income, but not enough for investors. The stock is trading down about 1.5% in after hours. So we're going to talk more about that with Robert Lee in a short while. But more broadly speaking, S&P futures tracking sideways movements today. Not a lot of green on the board. And this is after a moderate close yesterday. Investors once again really focusing in on some of those growth concerns as President Trump talks again about tariffs and the potential imposition of tariffs, not just on the EU, but on Mexico and Canada as well. So for that reason, we're seeing a bit of a jump in the USD today. It's up 0.2%, even though over the course of the last month, we are down 1%. Brent also continues to slide, once again paying attention to some of those growth signals coming through. The demand picture looking a little bit weaker. That is putting downward pressure on the energy complex. And then 10-year yields, wow, what a move over the last 5 days. We have traveled more than 30 basis points lower in the course of the last 5-6 trading days. So sitting at 4.27% now, yet again, as the market gets concerned about the global growth outlook. Flipping over, though, I also just want to point out that it's not just the global growth outlook that investors are focused on, but also some of the data that's come through from the U.S. And take a look at this. This is the Citi Economic Surprise Index coming in at the lowest level since September. And this just tells you that the data relative to expectations has been disappointing to the downside. So perhaps explains some of the movement that we've seen in U.S. Treasuries over the last 5 days or so. So I'll just leave that with you for now. But going back to the main earnings report overnight, Nvidia delivered good but not great quarterly numbers, drawing a muted response from investors accustomed to blowout results. So for more, Bloomberg Intelligence senior analyst Robert Lee joins us. First of all, Robert, I had a look at these numbers. I thought that tracking somewhat like an 80% or 78% jump in net income seems to be quite healthy, both on revenue and also on profits. Why were investors disappointed with these figures?
Okay, thanks for having me on again. Well, yeah, headline numbers are great, but that's what people were expecting. And I think on the margin, the degree of outperformance didn't exceed the very highest of expectations. I mean, there's something referred to as a whisper number in markets where there may be some official number penciled in for their future guidance, and maybe people are hoping or whatever that the company can exceed that. So I think in terms of their gross margin guidance for Q1 probably came a little bit below what this whisper number was, and equally for the revenue number. So in absolute terms, the numbers were beat, but that was well understood, well factored in and well anticipated.
Okay, let's talk about Blackwell. The Nvidia CEO, Jason Huang, said demand for Blackwell is, quote, amazing. I think there was some concern about what that figure was going to look like, especially surrounding the news of DeepSeek and what knock-on effects that could have for demand for some of these high-end Blackwell chips. But the messaging from the CEO has been quite positive on that front.
Just for a change. Yeah, I mean, Jensen Huang, far be it from me to criticise him in any way. He's the chief sort of salesman, chief tech evangelist, as well as the CEO. So, yes, a similar positive messaging as we've heard before. There were some production delays earlier on Blackwell. It's a highly technologically complex chip, so I suppose the market took comfort that they seem to have navigated the worst of those challenges. And it's actually increasing Blackwell production, which will depress their margins in the short term. So the company is looking for a gross margin rebound in the second half. So going back to DeepSeek, as you mentioned, again, this thing called Jevons paradox that probably none of us, unless we're economists, had heard about until more recently. I guess the argument that Nvidia and the market seems to be swallowing at the moment is that ultimately the reduction in cost that DeepSeek has delivered should ultimately drive an increase in or proliferation in AI applications. I would say that is a theoretical argument at the moment that will only become clear whether it's true or not, later in the year. So yeah, the messaging is positive. I think AI remains broadly on track, but again, what is anticipated and what is priced in by the market at the moment? There's clearly, a lot of very high expectations still priced in, which is why you're seeing the share price reactions.
Yeah, and I just wonder how much of this is alpha versus beta. If you look at more generally the moves in Magnificent Seven, we've seen a big pullback from where we were back in December. And I just wonder whether some of the reaction today is just a function of the broader market concerns as opposed to Nvidia specifically.
Okay, I think the narrative on AI is changing. Again, in the early days, it was all about hope and expectation. That's still true to a large degree. But now I guess it's, show me the money. And a point I continually make when we have our little chats is about monetization. So that isn't a problem, a direct problem for Nvidia itself, because clearly they're printing money almost at the moment. The issue is for the software companies that are spending vast amounts of capex. The big tech platforms in the US are spending somewhere close to $350 billion in capex this year. Yet the level of monetization that's coming through is still relatively low, and I would argue is not ramping at anywhere fast enough rate. So I think the narrative of AI is changing. Investors are more focused on the monetization, and I think this is potentially a year that these platforms need to prove themselves. If that doesn't come through, then it has potentially big implications for where the sector may go over the next couple of years.
Interesting. Well, for anyone who's watching, you heard it here first. And Robert, you were also one of the first analysts around to talk about the advent of DeepSeek many, many months before it was even on anyone's radar. So thank you for coming on our show and for the little chats. That was Bloomberg Intelligence Senior Analyst Robert Lee. Now, in regional news, Associated Press is reporting Hamas has handed over 4 dead Israeli hostages to the Red Cross in the early morning. Israel has now also released hundreds of Palestinian prisoners. The last exchange under this first phase of the ceasefire deal was delayed due to Israel's protest of Hamas's hostage release ceremonies. Let's bring in Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. So it looks as though this final exchange has taken place, but under, I would say, controversial circumstances the last couple of weeks.
Yeah, I mean, the main sticking point, I think, with these ceremonies, so-called ceremonies that Hamas was engaging in, which was clearly a publicity stunt and contravened, as far as anyone can tell, every agreement that was out there. And you even have the UN came out to condemn it because it's clearly not a great look, I would say, to the outside world to do that kind of thing. Nonetheless, we appear to have moved on from that. I think the release yesterday of the 4 bodies was done without ceremony. It was handed over to the Red Cross. So maybe that sort of sets a new precedent for things going forward. But again, we're in this incredibly precarious position. Phase 1 of the ceasefire ends on, I think, Saturday or maybe on Sunday. There's no clarity yet on whether that's going to be extended. I think all parties would certainly like it extended. What we've seen over the last few weeks is that Israel is again bringing troops to that border with Gaza. That's not to say it has any intention of resuming hostilities. It's merely sending a signal, we're ready to do this if you're not willing to basically engage in fruitful dialogue.
Yeah, and just as a reminder, the transition from phase 1, so phase 1 technically is about to end. We're about to transition to phase 2, but phase 2 will still entail the release of further hostages. It is thought that there are still about 24 or 24 hostages still alive. So there's pressure on Israel's side to secure the release of those hostages. But what happens after that?
Well, that's the problem. So you've had these long-running discussions that have been going on for months about what basic governance and security will look like in Gaza. And, you had sort of a late wildcard arrival from the Trump administration saying that it was going to take over and build this Riviera. I think, at least for now, that probably is off the table, although I noticed that Witkoff, his special envoy, said he's going to convene a summit of developers, including Arab developers, over the next few days. I don't know what that's going to look like. But again, it's going to come down to governance, and really you've got this sort of to and fro between the Arab nations, the US and Israel about how you construct a functioning government that everyone can have faith in.
Yeah, and it echoes some of the comments that we heard from Dr. Gargash yesterday. He was speaking at the Investopia conference in Abu Dhabi, just to give the Arab perspective. And he said there won't be any reconstruction unless there is also a credible political roadmap. So you're not going to get the developers come in before there's actually a proper path towards governance and who is going to be taking over administration of Gaza in the future. So those are the questions that will be discussed. Stuart, thank you very much. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Well, still ahead, hear why Callanish Capital says markets will see a more pronounced impact from AI-related stocks in 2025 as investors digest an underwhelming report from Nvidia. That's next, and this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumoke Oduwole in Dubai. President Trump gave contradictory answers at a cabinet meeting about his plans to enact tariffs on Canada and Mexico, as well as the European Union.
We'll be announcing it very soon, and it'll be 25%, generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
Meanwhile, a White House senior counselor for trade and manufacturing, Peter Navarro, explained why the U.S. president is also considering tariffs on copper imports.
We haven't opened any new smelters in a long time, and others are being opened around the world, and we're simply not having enough refining capacity. That's what we're trying to establish, and the problem is, if you look at the curves, we had a tremendous surge in demand for copper over the next decade because of the electrification of our economy, in part due to things like AI.
So more tariffs to talk about. Joining us is Haig Bathgate, director at Callanish Capital. Really good to have you with us.
Thank you.
So the latest tariff news, because every day there seems to be some tariff topic, but the latest one in the last 24 hours, President Trump has talked about imposing 25% tariffs on European imports. Do you see this as saber rattling or as an actual real threat to the European growth outlook?
Yeah, well, it seems to be a sort of trial and error approach, doesn't it? So he announced the tariffs a couple of weeks ago and then saw the impact it had in the markets, so reversed them out with Canada and China. I mean, we're seeing this sort of tit for tat with China as well at the moment. But the tit for tat is never really that serious. So it's things like, oil and gas or agricultural stuff that really China doesn't import from the US anyway, but it gives them the headlines. So I think there's still a lot of saber rattling, but at some point it starts to have an impact. I think the removal of the de minimis $800 tariff is quite a big thing, and you can start to see that hitting people like PDD and JD and so on.
I thought they had repealed that as well. It's tough to keep up with all of the news there. But let's just stick with Europe for a little bit, because we did have quite a consequential election over the course of the weekend, and now Germany's going to go through the process of putting a government together. But it feels as though the market once again is placing very high hopes on the possibility of debt brake reform. But if you look at the potential future composition of the government, there isn't a supermajority. There's not going to be 2/3 of a majority that would allow for a reworking of that debt brake. So are markets once again misplacing optimism and what Germany can achieve fiscally?
Yeah, I think so. And look, it's the same thing in the UK at the moment. We've got Keir Starmer running around talking about doing big defence spending and so on. I mean, at least he can do it in the UK, but I think in Germany it's going to be very difficult. You've obviously got the far right and the far left. You've got this multi-coalition, and it's going to be very hard for them to push anything through, I think, and to be united in terms of defence spend.
Yeah, and I mean, the signals that we're getting from Europe and UK as well, from Keir Starmer, that, okay, clearly there's going to be an intention to spend more on defence, but is that compatible with competitiveness? Because the big issue that Europe has, as identified by Mario Draghi, is one of productivity and competitiveness. If they start ramping up spending, hundreds of billions of euros on defence spending, is that going to do much?
Yeah, well, this is the problem, isn't it? You've got to have the support of the local electorate. And I think, in the UK, they're in a very precarious position. You've got the so-called growth budget that was anything but growth. And if people can continue to see their standard of living decreasing, which is what you're seeing in the UK, they're not really going to be up for funding a war effort in somewhere like Ukraine or a peacekeeping mission. So I think this stuff is very precariously balanced.
Yeah, and I feel like we have these big picture questions about where Europe is headed of the medium term, long term. But in fact, European equities have had a good start to the year, better so than US equities. What do you point that down to?
I think it's, it's a relief rally more than anything, isn't it? I mean, as you were saying just a few minutes ago, you've had this bit of a rotation out of the Magnificent Seven.
Yeah.
To me, this is a good opportunity to get back into the Mag 7. I think, when you see Microsoft down and so on, Microsoft have no problem with their margins. As you said, Nvidia's results were very good last night, but the market's just not rewarding them at the moment. So, I remember having this conversation at the start of last year and everybody was saying, have the Mag 7 gone too far at that point? And the S&P ended up the year 27%. To me, it looks like it could be another bumper year for the S&P.
But two things. One, valuations are higher. And two, you've got DeepSeek now, which has sort of changed the calculus of how much money needs to be poured in and how much CapEx spending actually needs to be invested into building up some of these hyperscalers.
Yeah, I think that's right, but it's interesting, isn't it? I mean, the DeepSeek technology is built on Nvidia chips. OK, it's slightly older technology, but there's two ways of looking at that. You can say, well, this is a democratization of AI technologies, but also this creates a whole new market that wasn't there before. To me, it becomes very polarized. You have the sort of A-team players, the chat GPTs, the Groks and the like, and then you're probably going to have this second tier, but that to me is just more demand for Nvidia chips ultimately. Yeah,
okay, so you would buy into Magnificent Seven, the pullback here. What about what's happening with fixed income? We've been rallying quite a lot recently in yield terms. Yields are going down. And again, the narrative has once again changed away from U.S. exceptionalism to U.S. growth concerns. The market narrative changes very quickly.
Well, that's the thing, isn't it? And what's driving concerns in the U.S., which is sort of tariffs and that having an impact on demand, is very different to what we're seeing in Europe, where it's actually just we're going to get a slowdown because the growth isn't there. But to me, the fixed income game is that is the obvious one. It's a pretty boring trade, but for once you're paid. In the UK, for example, you're paid almost a 5% carry. So even if inflation stays sticky for a bit longer, you've got a lot of capital gains built in there, and you're paid a high income carry in the meantime as well.
Yeah. What do you make of, I don't know if you're involved in crypto, but just as sort of a market participant, of the outflows that we're seeing out of the crypto space? Is that just, essentially a very leveraged bet on equities?
Yeah, we're not so involved in it. I mean, I'm not pro and not against it. Yeah. To me, it just seems to be a play in global liquidity. So when we see liquidity levels rise, and obviously there was a massive run into the year end when Trump presidency came through, when liquidity looks like it's drying up a bit more, crypto tends to sell.
Well, that's why I brought it up, right? Because there has been a massive outflow from the Bitcoin ETF, and technically I think Bitcoin is now in a bear market. So that actually could be a signal for other risky assets as well.
Yeah, I think crypto's quite unique though, isn't it? And you've got a lot of these sort of hedge funds who are just playing, because it's so volatile, a lot of hedge funds are sort of playing and exacerbating those trends, similar to what we're seeing in some of the tech companies. I'm not unduly concerned. I think it's just very noisy, isn't it?
Yeah, it is noisy. Good to have you on, Haig. Okay, thank you. That was Haig Bathgate, Director at Callanish Capital. Well, coming up, Trump tariff turmoil dominates the G20 finance ministers meeting as South Africa's president calls for unity amongst nations. We're live to Cape Town next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersechi in Dubai. South African President Cyril Ramaphosa has called on the G20 nations to tackle global challenges more decisively, citing the need for collective action to improve lives. The comments were made during Ramaphosa's opening address in Cape Town as his U.S. counterpart Donald Trump upends the world order in pursuit of his America First agenda. For more, Jennifer Zabazaja, our Chief Africa correspondent, joins us now from Cape Town. Well, Jen, you've been on the ground a couple of days. So much news coming from not just Cape Town, but also from the U.S. as well, with all of these statements from President Trump. essentially pursuing this America First policy, moving away from the multilateral framework, talking about tariffs. How is all of that being received by the G20?
Right. And Jumana, as you say, it comes at a time when we are hearing more of these leaders here, namely President Ramaphosa, trying to say that multilateralism is the only way to thwart a lot of the global crises and really it becoming even more dire than it is right now. And he talks about the need for the G20 to really be the forum in which to do that. Now, when we think about the messaging and the sentiment on the ground here, I would say it's one of cautious optimism. A lot of leaders who we've spoken to have said that they do acknowledge the fact that this is an important forum for them. The G20 has historically been one in which they do find cohesion on a number of issues. But there's also a very real acknowledgement that we are shifting away from that, at least if you take a look at where the global landscape is right now. Just a few leaders we spoke to, the German finance minister saying that he does believe that a lot of the priorities of the South African G20 presidency align with his country. We also heard from Irish Finance Minister Paschal Donohoe, who did say that this is a precarious time, talking about a lot of the difficulties as far as supply chain and trade tariffs and the rest go. But he does believe that South Africa and the South African G20 presidency could be a reminder of what can potentially unite them. But there is a very real acknowledgement, as I was saying, about what we are seeing from the West and really what the future holds for U.S. and some of these other big countries in this forum is a big question many people are asking.
Jen, and how likely is it we're actually going to get a joint communique put out today, given the fact that the U.S., the Treasury Secretary Scott Bessent isn't even there?
Yeah, not just Scott Bessent. We also have heard Japan, his counterpart from Japan, Argentina, Mexico, Canada, a lot of these countries that are critical to a communique being put out, not presently here. They do have representatives here. We've heard from a few officials, potentially we will not get a communique. There are still some very real gaps. Last week at the foreign ministers meeting in Johannesburg, we did not get a final communique, but one of the officials we spoke to yesterday said perhaps this is just an early in the year incident and we'll continue to see them work on a lot of the issues that they have and we get closer to an agreement later on in the year.
Yeah, and you've just got to wonder how much tooth these agreements will actually have, again, in an environment where the U.S. is deciding to withdraw from many of these multilateral frameworks. So it'll be interesting to see what actually comes out of that communique, if it comes out at all. Jennifer Zabazaja, our Chief Africa Correspondent in Cape Town, thanks so much. We'll be back with you in the next hour. A quick look at equity futures, not doing a whole lot today, but the market is reacting somewhat to Nvidia earnings coming through. A small dip for Nasdaq 100, down 0.1%. Now, coming up, we speak to Philip Bahoshy, founder and CEO of MAGNiTT, on why he thinks private equity deals are set for a comeback in the Middle East and North Africa. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. A victim of its own success, Nvidia delivers a good earnings report, but after 2 years of blowout numbers, investors were looking for more. President Trump says tariffs on EU products will be 25% and include autos, amongst other things. Plus, tariff turmoil dominates the G20 meeting. President Ramaphosa calls on nations to tackle global challenges more decisively. We're live in Cape Town. It is just gone 8:30 a.m. across the Emirates. I'm Jumana Versace in Dubai. The markets are not doing a whole lot today. We saw a moderate close for Wall Street yesterday. Today, S&P trading sideways, a bit of a dip for Nasdaq. Investors latching on to the signals that we got through from Nvidia earnings came through after hours yesterday. And even though we saw almost an 80% jump in net income, the stock is trading down 1.5% in after hours. A bit of disappointment coming through there, but you could say that there was a lot baked in. The other story driving driving market sentiment today is President Trump talking once again about tariffs, this time European tariffs of up to 25%. That gave a bit of a boost to the USD. It's trading 0.2% firmer today in trading, though still down 1% over the course of the last month. The Brent complex also coming under some selling pressure, so just shy of $73, even though today we're stabilizing. But again, the theme has been one of further declines in oil as the market is focused on that global demand narrative and the fact that tariffs and the imposition of tariffs on all of these countries around the world could be a negative for the global demand picture. And then 10-year yield, speaking of demand and global demand and the signals coming through from the U.S. economy, we have seen quite a substantial drop in yields and where they're trading. 4.27 is where we are at right now. We're about 30 basis points lower than where we were exactly 1 week ago. So big rally in fixed income taking place. But not just fixed income. Take a look at the route that we're seeing in the crypto space as well. Earlier on, we were speaking about it with a guest. But we've seen a bit of a shakeout here. Bitcoin is now technically back in bear market, so it's down 20% from the most recent highs. And here, Ether has lost pretty much all of the gains it posted since the U.S. election. Doge is now underperforming Bitcoin. Why do we talk about that? Well, because we know that Elon Musk loves it. So it initially did quite well. But as you can see now, it started to underperform quite substantially as well. So a lot of the hype around the crypto community, crypto markets, has started to be unwound. So something to bear in mind as well. Now let's switch over and talk about private equity. My next guest says the private equity market in the Middle East and North Africa could be set to start positioning for a long-term rebound this year. Data platform MAGNiTT expects investors to recalibrate strategies after a drop in deal flow. Joining me now is the founder and CEO of MAGNiTT, Philip Bahoshy. Good to have you with us, and also really timely for me because I'm heading over to Abu Dhabi after this, and I'm actually moderating a panel on private equity trends. So perfect timing. I'll sound very smart with all my panelists. Set this stage for us. What did private equity deal making look like in 2024 in this part of the world?
Well, I mean, firstly, I'd just like to say the context that private capital has become really a buzzword here in the region. I've been at conferences for the whole of last year and the beginning of this year, and even yesterday, His Excellency Mohamed Ali Al Shorafa, the Minister of Investment, is talking about the importance of private capital and specifically in private equity, the opportunities that present themselves. In the last 5 years, we've seen continued interest in that space, peaking in 2022. In the last couple of years, in line with what we track at MAGNiTT, the venture capital space, we've seen a decline because of the interest rate environment that we find. But the total number of transactions has remained relatively solid over the last couple of years, specifically in the UAE and Saudi Arabia, albeit we have seen a significant drop in the value of the transactions that have been taking place.
Yeah, and so how does the deal flow in the Middle East compare to the trends that we're seeing globally?
Yeah, interestingly, when you look at the US, you've seen a similar trend that we saw a decline starting in 2021 into 2023. Last year, though, private equity investments in the US grew both in terms of value and the total number of transactions. Yeah. Hence, we believe that 2025 is likely to be a pickup of investment activity here in the region.
Yeah, and in the region, I mean, specifically, it's two major markets, right? It's Saudi Arabia and the UAE. And I was speaking to one of my colleagues a few weeks ago about the IPO activity for 2024. And actually, in terms of listings, Saudi Arabia led the charge, but in terms of volumes, UAE saw a bigger amount of volumes in terms of total numbers. How does that look like in the private equity space?
So the report was a 5-year review of private equity here in the region, and 68% of all transactions have taken place between the UAE and Saudi Arabia. Naturally, with the economies being some of the strongest here in the region, they also facilitate much stronger and larger organizations which are ripe for private equity disruption. What has become interesting is the exit window, both for venture capital and in the private equity space. Yeah. And all of the exchanges in Saudi Arabia and Abu Dhabi and Dubai are very much focused not only in the tech space, but in the traditional business space for exit and liquidity for the market.
Yeah, one thing that stood out to me from your report in terms of deal structure, by the end of 2024, private equity, growth equity, and buyout transactions reached near parity, so around 51% to 49%. So that wasn't the case historically. Typically, there was more of a focus on these buyout deals as opposed to a growth equity. What changed?
Exactly. And 5 years ago, the traditional type of private equity investment would have been a buyout or even a leveraged buyout when credit was extremely cheap. The same thing in the US. In fact, they have seen add-ons, which are bringing together different companies as part of portfolios, being the dominant segment of private equity transactions. What we've actually seen is that the growth stage, which are minority stake investments over majority stake investments, have been the dominant type of transactions here in the region, solving the problem for late-stage investments of companies. And we expect that to begin to shift again if interest rates come down and acquisitions or majority stake transactions become more of the norm.
Interesting. What about exits? LPs obviously pushing for monetization. What does the exit landscape look like for PE?
So both in the venture capital space and in the private equity space, we expect that while valuations begin to come down over the interest rate environment that we've seen, that exits become a lot more attractive for M&A transactions. The IPO market is definitely key to seeing that liquidity for investors. But we anticipate that this year should be stronger than years gone by, but it will take the interest rate environment to come down to see that liquidity come into space and some regulatory changes for the exchanges to kind of see an acceleration of that IPO window kicking in.
Yeah, really interesting. Again, you're touching on sort of the overlap between some of the global trends and some of the local trends as well. Just in terms of sectors, you touched on this a little bit, but what would you say are the hottest sectors for private equity investments right now in the region? And I'm sure there's been a shift from where we were 5 years ago.
There have. Again, when you look at the 5-year view, the traditional industries are healthcare, telecoms, financial services. And even the last couple of years, they've remained relatively stable. Unlike in venture, where we look at e-commerce, fintech, logistics, here the predominant ones are healthcare, telecommunications, and financial services. Technology has grown in terms of interest and appetite, specifically in the UAE and Saudi Arabia, and that's something that we're likely to see going into the next couple of years.
Yeah, one last question, which I think is extremely relevant to this part of the world. Sovereign wealth funds are very active players in local markets. Does that crowd out private equity players, or does it help bring in some of these global funds into the market as well? I mean, how do you see the positioning of sovereign wealth funds?
I think this was a hot subject yesterday at Investopia, where they were discussing this, and in fact, His Excellency was talking about that. They're catalyzers of the space. Private capital has become a hotbed of activity as a diversification from the public markets. They're acting as a catalyzer. Yes, it creates some element of competition, but they also end up becoming the LPs of the GP funds. So we're seeing a re-emergence of the sector for private equity. They act as the LPs for the traditional GP funds, and then moving forwards, they can also help become the potential acquirers of many of the companies for liquidity.
Yeah, so interesting. Phil, great to have you on, as always. That was Phil Bahoshy, founder and CEO of MAGNiTT. Well, the UAE's Economy Minister says the non-oil sector has been a key driver of economic growth. Speaking to me at Investopia in Abu Dhabi, His Excellency Abdulla bin Touq Al Marri added that the real estate sector is robust and expected to grow.
The non-oil GDP really drove the growth in the economy in the last 3.5 years. We've seen the fluctuation and volatility in the oil prices and the demand as well. We've seen it from the OPEC, the demand on oil and the forecast for the 2050. And that's going to stay, that's the demand's going to be. But we've seen that kind of changes in the diversification, and specifically in the energy transition aspect, and that change as well. This is the important aspect to where we are taking forward the movement to it.
When you look at real estate, specifically what has been happening with real estate prices in Dubai, are you worried that we're getting to too frothy levels, bubble territory there?
Well, the demand, what we've seen today in the real estate in general, in the UAE, we've seen there is actually goes to the end user who buys the real estate, and this is for the first time we'll see that the end user is really benefiting and looking for the real estate. It's not like used to be globally creating real estate bubbles, but the UAE has, in Dubai specifically, a very, very clear, and there are many more keys are coming in this year. That we're seeing high net worth individuals. Last year we were topping the world in the reports, 6,000 plus high net worth individual moving in. This year as well, we're expecting the thousands. Hopefully we beat the last year's number. But we see this kind of movement and that demand for creating as well a real estate sector that really attracts high net worth individuals, attract people, attract a skilled workforce that actually to grow the economy.
If there is a resolution to the Ukraine-Russia war, are you bracing for the potential departure of some of the people who moved into the UAE once the war started?
Well, since the war started, we were actually advocating that we should stop the war and peace should be the aspects, and that's something which we always push for. And the UAE's vision is actually to have peace. In the end of the day, is economy that really creates, and what UAE have shown is a very robust environment and economy that actually welcomes people in and out, and I think that's something which we'll always keep on doing. We have agility in our economy, and that's what investors looks like I said at the beginning. Investor looks for rule of law, looks for stability, looks for money in and out, ease of moving of cash flow and moving of products. So it builds a huge thing. We used to be a seaport in the 60s, 70s, an airport in the 80s, 90s. Today we are a brain port. So we're really connecting the world as well together. So we're always going to be in this game, and we're going to continue that.
That was UAE's Economy Minister, His Excellency Abdulla bin Touq Al Marri, speaking to me at Investopia in Abu Dhabi, and I'm heading back there in a couple of hours. Now, coming up, we will speak with the International Finance Corporation, the IFC's regional VP for Europe, Latin America, and the Caribbean. That is next, and this is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumoke Oduwole in Dubai. UAE firms are actively expanding into Latin America, focusing on various sectors to strengthen economic and strategic ties. Joining us is Alfonso Garcia Mora, International Finance Corporation's Regional Vice President for Europe, Latin America, and the Caribbean. Well, our readout to you was talking about how the UAE has set its eyes on Latin America, but it's not just Latin America, it's other countries in the global south as well. And I think this is a theme that is becoming a lot more dominant. What we're beginning to see is more and more south-south lending, so to speak, from global south countries to other global south countries. What do you put that down to?
So that's totally true. And to give you one data point, in 2000, the beginning of this century, developing economies represented 20% of the global GDP, and today it is 50% of the global GDP. So it gives you a sense on how these economies have grown, and they are really being or are attracting financial flows from other countries that are actually in the south as well. So the flows that we usually had, that was north-south, have been changing and are changing to a much more south-south exchange.
Yeah, in the case of UAE, because we're speaking from the UAE now, and we know that the UAE has been actively investing in countries in Africa, in Latin America. What is the investment opportunity that they are seeing specifically?
So what I think is that Latin America is a region that is a little bit far away from the Middle East, and therefore is not the
geographically not the most logical
It's not
option.
the logical one, and actually very close to the US. So the US was the main investor, has been the main investor. Other countries like Spain investing a lot in Latin America. But the opportunities are there. For instance, critical minerals, 50% of the lithium reserves are in Latin America, between Argentina, Chile, and Bolivia. So the opportunity is huge. This is a critical mineral for many things that we are developing, electric vehicles, etc. No? Another one, 60% of the biodiversity that exists in the world is in Latin America. So if you really want to work in that space, Latin America is the place to go. Or another one, the main food producer in the world is actually Latin America. Yeah. So with all the food security issues and the demographic trends, etc., Latin America will play a critical role on the agribusiness space.
Yeah, and what specific expertise are these countries coming from the GCC lending to the countries on the ground?
So I think that there are three areas where the GCC has been, or is actually absolutely a reference globally. One is renewable energy, clean energy, and they have been very, very active. Masdar has been very active in many countries in the world. Sustainable development in general, but also infrastructure, for instance, logistics, which is a key thing, especially in a region like Latin America, where there exists a lot of lack of intra-trade across countries in Latin America, and therefore the need to actually strengthen the logistics and the logistical framework to make the trade flows more active within countries is going to be critical.
Yeah, it's funny, when you're talking about Latin America, obviously it's situated close to the U.S., seeing less and less investments or even focus, actually, from U.S. leadership over the last decade. that created a window of opportunity for China investments, and that's actually become almost, it's moved to the political forefront of the debate now with the discussions around the Panama Canal, et cetera, et cetera. I don't want to ask you about the political ramifications. What I do want to ask you is why also now you're getting new entrants like the UAE also beginning to look at opportunities there. Is it because countries in Latin America simply want to diversify some of their trading partners and not just be too reliant on China or
So that's a good point. I think that definitely diversification of sources of funding is an important point. And second is the magnitude of the needs that they have. And they need to really bring expertise from across the world. I mean, if you think about three big trends that exist in Latin America, in the world, but also in Latin America, demographics, urbanization, industrialization. The three of them in Latin America are booming, and you really need expertise that can help you to finance that. To give you a very concrete example, I was in a city in Argentina a few months ago, Cordoba.
Yeah.
It's not the largest city in Argentina, no? And actually one of the main investors in Cordoba is the Abu Dhabi Development Fund. And I didn't know that. So it's a good example of how the financing is coming from different places beyond the traditional sources of fund that these countries used to have.
Yeah, going forwards, do you think that there is going to be more of a focus on logistics, though, simply because one of the other major developments that has happened in the world the last few years is deglobalization, reevaluation of supply chains, reshoring, and a reevaluation of some of these logistics chains. And I do wonder whether there's also a strategic opportunity in that space, too.
So definitely, and I would say two big reasons why I think that this is going to happen. One, because the intra-trade in Latin America is very small. So basically, this is the region in the world with the few connection between countries. One reason is because 80% of the population live in the coast, and therefore, actually, when you look at the map of Latin America at night, this map with the lights, you see perfectly well the perimeter of the region. No? But there is a need to really interact and make the countries closer. This is one thing. But the second one is the nearshoring that you mentioned, and I like to call it green shoring in Latin America. Why? Because 50% of the energy in Latin America is renewable, so it's clean energy. So for a company that wants to diversify and wants to really increase their or decrease their carbon footprint and the sustainability ratios, etc., sitting in Latin America and using the green sources of funding is also a good example of how they can achieve two objectives by one decision.
Yeah, so interesting. Well, great to have you on. I'm sure it's a topic we're going to hear more and more of in the coming years. Alfonso Garcia Mora from the International Finance Corporation. Now, coming up, the Trump administration dismantles a U.S. initiative to increase electricity supply in Africa. We'll discuss what it means for sub-Saharan Africa next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumoke Oduwole in Dubai. The Trump administration has dismantled Power Africa, a U.S. initiative to increase electricity supply in Africa after more than a decade of work. Almost all of Power Africa's programs have been listed for termination and the majority of its staff fired. For more, let's bring in Bloomberg's Matthew Hill in Cape Town. Matthew, another pretty dramatic decision out of the U.S. administration. Tell us more about Power Africa and also how this move fits into the other decision by the U.S. administration to reduce U.S. AID spending.
Yeah, exactly. Just starting off with U.S. AID. So Power Africa operated underneath the U.S. AID program and had been initiated during the Obama administration to essentially connect African homes and businesses to electricity. And what we are told is the vast majority of the programs operating under U.S. AID's Power Africa program have been terminated and the staff have been fired. So the impact of that decision on Power Africa is vast.
Yeah. What sort of impact are we looking at? I mean, already we talk about the energy poverty that almost half the continent lives under. How is this going to make things worse?
Exactly. In Africa, you've got about 600 million people who do not have access to electricity. It's the least electrified region in the world. And Power Africa was trying to change that. So when you look at the context of other big cutbacks in aid, the UK, for example, making an announcement this week about that, it just makes things much more difficult to get development happening in this continent.
Matthew, thank you for bringing us that very important report. Bloomberg's Matthew Hill, thank you so much. Now, Cape Town is set to accelerate its switch to green energy and limit reliance on erratic supply from South Africa's state power utility after securing a loan from Germany's KfW Development Bank. The €150 million loan will be used to bolster the power grid of the country's second biggest city to allow the transmission of more renewable energy. The investment comes as cities in South Africa push to reduce their reliance on Eskom because of surging electricity prices and frequent power cuts. So it should be said that some of the load shedding has been dramatically lower than it was versus a year ago in South Africa. That's one of the positives of the new administration since the elections. All right, let's take a look at how some of these key equity markets are faring. The big news overnight was that of Nvidia's earnings, disappointing to some investors. The stock is trading down 1.5% in after hours, dragging down the Nasdaq slightly, albeit really marginal amount, down about 0.8%. S&P futures not doing a whole lot, up about 5 basis points. But again, the market seems to be now centered on this narrative of weaker U.S. growth, as U.S. growth data has started to surprise to the downside. So that has been one of the major themes driving some of these indices and fixed income in the last couple of sessions. But coming up in the next hour, we will be discussing the turmoil from tariffs, the mood amongst finance ministers of the G20, and the South African economy with our guests. I'm Jumoke Oduwole in Dubai, and stay with us as Jennifer Zabazaja joins us next. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. A victim of its own success, Nvidia delivers a good earnings report, but after 2 years of blowout numbers, investors were looking for more. President Trump says tariffs on EU products will be 25% and include autos, amongst other things. Plus, tariff turmoil dominates the G20 meeting. President Ramaphosa calls on nations to tackle global challenges more decisively. We're live in Cape Town. Well, good morning, everybody. It's just gone 9 a.m. across the Emirates. I'm Jumoke Oduwole in Dubai, and joining me is a very special guest, Jen, in Cape Town, where you've been the last couple of days, Jen. Not guest, I should say.
Yeah,
anchor.
Jumoke, we're wrapping up the G20. Yeah, we're wrapping up the G20 finance ministers and central bankers meetings here in Cape Town. It's just gone past 7 a.m. Welcome to the second hour of Horizons Middle East and Africa. Jumoke, great to have you back.
Yeah, no shortage of things to talk about, and certainly want to pick up on some of the key themes coming out of the G20. But of course, there's one man behind all of the news flow in the last couple of days, and that is none other than President Trump. And markets are reacting once again to his proposal to impose 25% tariffs on European products. So that was the latest on a tariff front yesterday. So yet again, another perhaps dampener when it comes to the global growth outlook, and markets are latching onto that. So that is one of the reasons why we're seeing a bit of a subdued trading today in markets. S&P futures not doing a whole lot, trading sideways. Of course, we did have Nvidia earnings come through as well overnight, and even though we saw a big jump in net income, the reaction in after hours has been pretty muted as well there. So Nvidia stock down 1.5%. The USD jumping 0.2% today on back of those latest tariff developments, tariff announcements out of President Trump. And then the energy complex continues to struggle to get some support here. We are trading below $73 now, about 0.3% firmer on the day, but still down about 3% over the course of the last couple of days. And then 10-year yields, a massive slide lower over the last week. We are about 30 basis points lower from where we were about 1 week ago. 4.27 is where we are right now. And because of, let's flip over, some of the weakness that is coming through in terms of the data. This is Citi's surprise index. And you can see the economic surprise index is now the lowest level it has been since September, telling you that the data that has come through, including those confidence figures a couple of days ago, have surprised to the downside versus market expectations. And that is sort of setting the tone for some of these key financial assets.
Yeah, that's right. Let's dig into that Nvidia story, though, Jumana. Nvidia delivered good but not great quarterly numbers, drawing a muted response from investors accustomed to blowout results. For more, let's bring in Bloomberg Intelligence senior analyst Robert Lee, who's joining us. So, Robert, apparently good but not great. Outperformance is not exactly what investors were expecting. Why did these results underwhelm?
Okay, great question. So, I mean, investors, particularly with Nvidia, have become used to this diet of so-called beat and raise. So I think the level of incremental beat and guidance raise is diminishing over time. Now, maybe that's just a factor and a function of the mathematics and the numbers as the base becomes higher. But, you know, there is a backdrop, and if you remember the story that broke, I think, from a US broker on Friday last week, questioning whether Microsoft was cutting some data center rental. So, you know, the narrative, I think, on AI is beginning to change. Not that it's turned negative in any way, but this sort of very ebullient, bullish sort of view is taking a slightly more rational approach now, and people beginning to question for how long the high levels of capex spending can be maintained within the industry at a time when the monetization by the software companies, in other words, the companies buying these chips, remains relatively low. So I think the narrative is changing more into monetization. We're investing in the infrastructure. We're spending ginormous amounts, $350 billion on capex between the large US tech platforms this year. You know, show me the money, basically. Where's the monetization? So I think, again, given that backdrop, no wonder, you know, solid numbers, but lack of incremental upside on the guidance. No wonder we're seeing a bit of profit taking.
Robert, is that why potentially, or does that speak to the alternative narrative then here, potentially the bearish case against Nvidia and AI more broadly, or is there another narrative that we have to dig into?
Okay, so when DeepSeek broke just over a month or so ago, obviously there was a big sell-off within the sector, but I think people and, again, Jensen Huang, the counter-argument that they gave at the time, based on something called Jevons paradox, which I guess, unless you're an economist, few of us had heard of previously. You know, lower-cost model development will ultimately lead to a proliferation in development activities as the technology becomes cheaper to access, a so-called democratization of AI development. That remains a theoretical argument at this point. There's no evidence to suggest either way that it's going to be true. I think we'll only know in the fullness of time through the end of this year whether that happens. So I think there's that underlying uncertainty that's there. And then more specifically on Nvidia at the moment, we've got a new president in town. I think the risk of further sanctions on the China side that could potentially negatively impact Nvidia's business remains a very real risk. So if you look at the balance of risk-reward in Nvidia, again, this was a stock which was very highly valued, priced to perfection, some would argue. I think the risk profile for the company now is arguably more biased to the downside. So again, competition is increasing. Some of their customers are developing their own chips. We've got the uncertainty relating to tariffs and what President Trump could do. And then we've got some residual risk on the Blackwell ramp because whilst they had some production problems earlier in the year, or last year I should say, they've navigated them, but there still is residual risk on that. So I'm not questioning the fundamentals for Nvidia at the moment, but as everything within listed markets, it's the balance of risk reward. And then going back to your preview, your intro comments a few minutes ago, I mean, risk aversion is creeping into markets at the moment. So net, given the backdrop, given the specifics on Nvidia, you know, we didn't see enough incremental upside. And, you know, I think it's for them to prove this year that, you know, they can deliver on these very, very high expectations. But lastly, and I'm repeating myself deliberately, the big question people need to bear in mind for this year on AI is monetization. The level of monetization coming through from the big US tech platforms or the big platforms here in China is nowhere near high enough to justify the very large amounts of capex being spent, in my view.
Robert, always great to get your analysis, especially on a big story like this. That is Bloomberg Intelligence senior analyst Robert Lee joining us there on Nvidia.
Well, over in the Middle East region, Associated Press is reporting Hamas has handed over 4 dead Israeli hostages to the Red Cross in the early morning. Israel has now also released hundreds of Palestinian prisoners. The last exchange under this first phase of the ceasefire deal was delayed due to Israel's protest of Hamas's hostage release ceremonies. Let's go to Jerusalem now and speak to Bloomberg's Dan Williams. Just give us a sense of what exactly has taken place this morning. We know that the exchange of hostages for prisoners has been delayed, and there was some controversy around the release of the hostages. How do things look right now?
Well, good morning. The execution of this deal is a reprieve from the recrimination and disruption that plagued this first phase of the Gaza truce over the last week. There was a resolution in terms of Hamas agreeing or being compelled to return these 4 bodies to Israel under cover of dark, with a reduction of the ceremonies that accompanied previous hostage releases, and which Israel and much of the world found deeply offensive. So that was performed, and as a result, Israel is due to be releasing some 600 Palestinian prisoners whose release Israel had held up in protest at those ceremonies. Now, it's worth noting that we're basically at the end of phase 1. The completion of this stage completes phase 1. It's due to expire in just about 2 days at the weekend, and it's still not clear if it might be extended or if a satisfactory phase 2 will be clinched between the sides, given that the phase 2 is an existential phase. It's a phase that would effectively put an end to the war, in which Israel wants to see a post-war Gaza without Hamas in charge, without Hamas being armed. It has the support of the Trump administration on this. Hamas has given no indication it will give up its weaponry. So it's very hard to know how to get there. So the question is, will they be able to extend phase 1 with fewer long-term commitments and a continued measure of hostage releases by Hamas and reciprocal releases of Palestinian prisoners by Israel? It's all up in the air.
Yeah. Well, Dan, there are reports that Israel has been sending troops back to the Gaza border. How should we read that?
Well, it's definitely signaling intent to resume the war should this truce break down. Keep in mind that truces are by definition temporary. They're self-interested. Warring sides don't enter them because they're at peace. They enter them because it serves their interests to temporarily cease hostilities. So Israel is saying, okay, well, if there's no phase 2 or if phase 1 ends without extension, then there's really no alternative but to resume the war and return our hostages through force. And in fact, the Israelis have given some detail about what a resumed war would look like. They say it would be more intensive than the 16 months of war that preceded this truce. It would involve potentially the cutting off of humanitarian aid and fuel to Gaza, which Israel says has been essentially been diverted to fuel Hamas's war machine, its fighters, its underground ventilators that allow bunkers and tunnels to function out of Israeli view. So I think it's worth taking this position, this signaling seriously. It is saber rattling, but that saber could be drawn very soon.
Very clear. Bloomberg's Dan Williams in Jerusalem as we head into a crucial couple of days for those potential talks surrounding the extension of the ceasefire. Now, still ahead, hear why PineBridge Investments expects more Fed rate cuts this year as President Trump moves ahead with his tariff threats. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Versace in Dubai. Traders are now betting that the Fed will soon need to pivot from worrying about sticky inflation to fretting about slowing economic growth. That sentiment has pushed Treasury yields lower for more than 5 straight sessions. Happy to say that joining us now is Omar Slim, MD, and co-head of Asia Fixed Income at PineBridge Investments. Omar, I've got to say, full disclosure, I was actually out of the office the last 5 days, so I missed the catalyst for the fixed income rally. And I came back and I see 10-year yields are at 4.27%. What happened? What was the initial catalyst for U.S. Treasuries to start rallying so much in the course of the last week? What changed?
I think what's changing is the narrative that the Trump trade is inflationary, or Trump trades, I should say, because there's a few of them. I think the kind of direct catalyst for the big part of the rally last week was that we're seeing cracks in terms of consumer confidence out of the U.S. But I think what we have been seeing for the past 10 days is that there is a bit more of a fading of the Trump policies, particularly when it comes to the concerns about the inflationary aspect of tariffs. I think that is probably something that will continue for the foreseeable future, except that I think when the actual tariffs will be imposed, we could see a backup of yields, but our view is that yields will continue to kind of trend lower.
Okay, so well taken, the point on tariffs. What about the fiscal premium? It wasn't that long ago that everyone was talking about the state of the U.S. deficit, the potential for unfunded tax cuts. What have you heard from the Treasury Secretary, even from President Trump, that has reassured you on that front?
So I think reassuring us or me or the bond market, I think it's taking it a bit too far at this point. But at the very least, what the market is focusing on two things. The first thing is what Doge is doing in terms of savings. I think the market is still relatively skeptical, but I think it's giving that a chance in terms of savings. And the other thing is that there has been some announcement in terms of the budget, including yesterday's, and that indicates that there will not be kind of a substantial increase in terms of supply of treasuries. And the third thing is when it comes to Trump policies or the Trump trade, one of them would be the fact that it's expected that he will be expansionary when it comes to the fiscal. But I think that is probably more of a story of 2026 and will be a bit more slow moving as opposed to what the market is focusing on now, which is tariffs. So I think fiscal is probably more for next year than this year. Until then, my view is that we're going to see yields kind of trending lower.
Yeah, interesting. And we've got about 58 basis points worth of cuts priced in until the end of 2025. Do you think that market pricing will be validated?
Well, the market has been quite fickle, I would say, in terms of Fed cuts, in the sense that the consensus is very fickle and there is very kind of large swings in terms of what the market is expecting. So we went from expecting, 4 to 6 cuts to expecting almost none to now expecting maybe 1 or 2. My view is that for the first half of this year, expecting that the Fed will be on hold is reasonable, till June perhaps, because the Fed has essentially said that they're going to stay on hold and see what policy is about. But after that, I think the Fed might be cutting a bit more aggressively than what the market is thinking right now, partly because I don't think in the grand scheme of things that the tariffs, immigration and so on will have that much of an impact in terms of inflationary trends. And I think the kind of the narrative that inflation is sticky is not really, sticking well. And to say it that way, I think this is essentially something that the market will question in the second half of this year, and I think the Fed will have the chance to cut more aggressively.
Yeah. Okay, so granted you're sort of bullish fixed income in the U.S., I want to lean into your Asian fixed income expertise, because there's one part of the market that has not been rallying, and that's JGBs, because of some of the hawkish commentary that's come through the last couple of weeks. Do you think that the sell-off in JGBs now in Japanese bond yields is overdone, or will we keep repricing higher?
No, I think it's not. I think this move has legs, because I think one of the things that you hear the BOJ speakers, including Ueda-san, talk about is homegrown inflation in Japan. And I think that has taken hold, and that will allow the Bank of Japan to continue to hike gradually, very gradually, maybe another 25 to 50 basis points this year. So Bank of Japan is, a pretty strong exception in terms of what we're seeing in terms of the global monetary policy. I would say that when it comes to the JGB in particular, there has been a bit of a reluctance to kind of engage in certain segments of the JGBs because the Bank of Japan is signaling that they will continue to go into neutral. And that has been very well telegraphed, and intentionally so, because I think the Bank of Japan has been, since it started kind of changing its position about a year and a half ago, they have been telegraphing quite clearly what they want to do because they don't want to have any wobble in the financial system.
Yeah, very clear. Well, great to have you on our show, Omar. Thanks for joining Horizons today. Omar Slim, MD and co-head of Asia Fixed Income at PineBridge Investments. Well, coming up, Nigeria's Industry, Trade and Investment Minister speaks to Bloomberg about the nation's FDI reforms and intra-Africa trade. Stay with us for that interview next. This is Bloomberg.
Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, Nigeria's Minister of Industry, Trade and Investment has been discussing intra-African trade development on the continent. He spoke with our Jumana Bersechi at the Investopia in Abu Dhabi.
Well, now what we've been doing is focusing on areas that G2G, as sovereign wealth authority, is de-risking a lot of transactions where we want to attract businesses from certain governments. We've identified UAE as a partner nation, and so those investments, depending on the transaction, you structure it in such a way that it's a win-win for everybody.
Yeah. Well, we talked about the trade between the UAE and Nigeria. Let me just ask you about intra-African trade. How do you rate the progress so far on the AFCFTA?
It's been 5 years and the trade has begun. This is now an inflection point, the 5-year assessment period. A country like Nigeria, just in Addis Ababa last week, was named Digital Trade Champion.
Yeah.
It's an area we're competitive. We're leaning on services, over 50% of our GDP. It's where our young people are competitive, over 200 million people. As you know, out of 9 unicorns on the African continent, 5 are from Nigeria. So we continue to push in this area. Agriculture is also a great area, and exports all across. It gives companies from other regions an opportunity to access a market of over 1.4 billion people.
Yeah. Do you feel like there is more of a pressing need now to encourage intra-Africa trade because of some of the geopolitical barriers that are going up, the trade barriers that are going up, led by none other than the President of the United States?
Well, it's a great question, and we talked about this in Addis last week. And the Africa Club had a breakfast. That's the multilateral institutions from Africa, AFRIXIM, AFDB, African RE, and they catalyzed over $70 billion in 1 year for capital across the continent. I mean, this is where we need to put on our big girl shoes and big boy shoes and leverage capital and new relationships to make sure that Africa doesn't lose out, doesn't feel destabilized, the dependency syndrome doesn't work. So in as much as we've valued strategic partners over the years, it's also a good time to form new relationships. That's why we're here.
Yeah. Do you have a target for how much inter-Africa trade you're looking at?
Certainly the more, the better. I'll keep my figures close to my chest.
Yeah.
But we continue to make sure that, particularly in the areas, the sectors that we've chosen, we've identified the trade patterns, the values attached to that, and we're going to leverage and optimize the agreement as much as possible.
Well, that was Nigeria's Minister of Industry, Trade and Investment speaking to me yesterday at the Investopia conference in Abu Dhabi, and I'm headed there shortly. A quick look at equity futures now before I head out, and we'll leave you with Jennifer. But this is the picture for equities leaning towards the green, actually, now. S&P futures up 0.2%. NASDAQ brushing off some of the original concerns that we had earlier in the session. Nvidia posting after hours results. A little bit disappointing to some investors. The stock was trading in the red, and now you can see that NASDAQ as a whole has turned around. We're trading back up in the green again. But Euro stocks, as you can see, down 0.5% as President Trump has once again floated the prospect of 25% tariff rates on European goods. So that is the reason for European markets coming under pressure this morning. But coming up, the turmoil from tariffs and trade tensions dominates conversations at the G20 finance ministers meeting. Jen will be speaking to Andrew Matheny, the South Africa economist at Goldman Sachs. Next, this is Bloomberg.
This is Horizon's Middle East and Africa. Our top stories this morning. A victim of its own success, Nvidia delivers a good earnings report, but after 2 years of blowout numbers, investors were looking for more. President Trump says tariffs on EU products will be 25% and include autos, among other things. Plus, tariff turmoil dominates the G20 meetings here. President Ramaphosa calls on nations to tackle global challenges more decisively. We are here in Cape Town with all of those updates. It has just gone past 7:30 a.m. in South Africa. I'm Jennifer Zabasaja in Cape Town here at the G20 finance ministers and central bank governors meeting. Welcome to Horizon's Middle East and Africa. And we've been talking all morning about the market reaction to Nvidia and more broadly what we're seeing across markets this morning. Let's, though, check in on how markets in Asia are faring. Avril Hong is standing by in our Singapore studio with more on that. Avril, what's got your eye this morning?
Well, it's how bad the selling is in the Asia Pacific. I mean, we saw how stocks across the region decline, and the Hang Seng, it was really interesting, actually managed a rally of 1+% at one point, but then shares retreated, joining the rest of the region, and this is the picture you're seeing across the board. So it looks like that US-China tech decoupling narrative is something that we'll have to wait a while more to see it materialize, so to speak. Of course, layered in the declines today is the tariff uncertainty, the confusion surrounding Trump and, the tariff timing as well as scope. We are going to be watching out very closely for next week, China's 2 sessions. When that kicks off, it is, of course, a meeting of the top officials in the country. Now, I also want to highlight the reaction we're seeing among the Asia chip stocks. The Bloomberg Asia Pacific Semiconductor Index is down for yet another day. It hasn't gained at all so far this week. And indeed, this is constituents of, TSMC. We have it in the mix in that basket there. SK Hynix, Samsung Electronics as well. These are all the Nvidia suppliers. And you can tell that, Nvidia is not really giving that spark, the kind of effect it used to have on some of these Asian chip names. Jen?
Yeah, that's right. Thanks so much, Avril Hong in Singapore for us. Let's focus in, though, now on South Africa, where the G20 meetings are currently taking place. The turmoil from tariffs and trade tensions is the topic dominating many conversations here on the ground. As President Trump upends the world order in pursuit of his America First agenda, the uncertainty is also clouding the global inflation picture as well as here in South Africa. Annual CPI rose 3.2% in January, giving policymakers reason to be cautious about cutting interest rates next month. Let's discuss all this and more with Andrew Matheny, South Africa economist at Goldman Sachs, joining us from Johannesburg. Andrew, great to get you on the show. Let's just start then with inflation and this print that we did get on Wednesday. Were you surprised by this acceleration print that we received?
Yeah, good morning. It was a pretty modest uptick to 3.2% year-on-year for headline, 3.5%. See a decline year-on-year for core. This, really follows from 6 months of, mostly pretty large kind downside surprises to inflation. Inflation is tracking well below the SARB's 4.5% target midpoint. So, yes, an uptick, but, we still think that the outlook here is pretty benign. We're expecting annual average inflation this year of 3.5%. That's well below official and consensus projections. And, I think there are two, main arguments that we make. One is that, in our view, the economy has been operating well below potential for quite some time, and a large negative output gap has accrued, and we think this has, is, and will continue to be disinflationary. And so I think there's a negative demand side effect on CPI. And then the second is that, you've had several supply shocks in the last couple of years in South Africa, and for food prices in particular, and we're coming off of these supply shocks. And, as these supply shocks fade, that is also implying a disinflationary impulse. So food inflation, notably in the print yesterday, eased further to 2.3% year on year, and we expect that to remain pretty subdued over the course of the year.
Right. But Andrew, earlier in the week, we were speaking to SARB Governor Lesetja Kganyago, and he expressed a bit of caution about the disinflation process itself, given a lot of the uncertainty right now. Is the Reserve Bank being a bit too cautious in your mind?
So, look, in our view, there are two dynamics at work at the moment. The domestic dynamics, we think, have been really pretty unambiguously, benign and dovish, and that's how we got, inflation falling down to 3%, core inflation, underlying inflationary measures tracking well below the target midpoint. On the other hand, though, the external backdrop has become a lot less favorable, and we saw this in the SARB's November meeting, where the communique was a lot more hawkish. We saw this even further in the January meeting, where you had two hawkish dissents in favor of keeping rates on hold. And, this is primarily all of the uncertainty on the, on the global side with respect to trade tariffs, the strengthening of the dollar that's taken place in the last few months, and the hawkish market repricing of expectations for the Fed. So I think that is, first and foremost what the governor and what the hawks in the committee are worried about. They're very sensitive to the exchange rate. And that, we think will keep them on the sidelines for a little bit. We had an expectation that they would be cutting at the next meeting in March. We've actually pushed that back. We do think that if our inflation forecasts play out, there will be space for further easing, but that the risk is that this is going to become much more backloaded.
So you do expect to cut those still in 2025?
Yes, we've penciled in cuts, a cut at the May meeting and then every other meeting down to a 6.5% terminal rate. And the way that we get there is that, in our view, inflation is likely to stabilize at about 4% in the medium term, so undershooting the target midpoint on a persistent basis. And then we add into that the same 2.5% neutral real interest rate that the SARB assumes in the steady state, and that's how we get to the 650. So in our base case, we'll get there sometime in the first half of next year. But, I think, as I said, I think the risks are that this becomes a more backloaded cutting cycle.
And Andrew, just finally, as an economist and a forecaster, how are you pinpointing the direction of travel, just given all of the uncertainty that exists right now in the global space?
Yeah, look, I mean, I think, South Africa has a little bit of an idiosyncratic story whereby, this time last year, growth prospects were very dim, load shedding was rampant, there were widespread expectations that you would continue to see fiscal slippage, and obviously major elections coming up, and fast forward a year, and I think across all dimensions, you've seen an improvement. Load shedding has really diminished considerably. There's more optimism on the growth side. We're still waiting for those numbers to pick up, but that's an improvement. And then the market welcomed the election outcome, and and some reforms that might come from that. So investors are waiting for growth to pick up, for fiscal numbers to improve, and waiting to see how this government of national unity holds together. Our expectation is that you will continue to see these three things in place, and that should lead to better economic and certainly also better market outcomes in the latter half of this year in South Africa.
Right. Right, and of course waiting for that budget to come, that postponed budget to come in just a few weeks. Andrew Matheny, South Africa economist at Goldman Sachs, joining us from Johannesburg. Andrew, thanks so much for joining us. Now, here's a few other stories we're following this morning. Cape Town is set to accelerate its switch to green energy and limit reliance on erratic supply from South Africa's state power utility after securing a loan from Germany's KfW Development Bank. The 150 million loan will be used to bolster the power grid of the country's second biggest city to allow the transmission of more renewable energy. The investment comes as cities in South Africa push to reduce their reliance on Eskom because of surging electricity prices and frequent power cuts. Ghana's cocoa deliveries are running roughly 70% ahead of last season, helped by an increased harvest and efforts to reduce smuggling. Most of the beans delivered to warehouses are destined for export, though some are sold to local processors. The market is closely watching supplies from West African growers after poor harvests last season fueled a huge global shortage that sent prices soaring to a record. The World Bank says Zimbabwe could clear its arrears and rework the $21 billion debt that's kept it locked out of capital markets for more than a quarter of a century if it implements fiscal reforms. Changes the World Bank recommends include removing exchange rate distortions to enable stable inflation and reducing the public sector wage bill by eliminating duplicate and redundant roles. And Kenya has sold $1.5 billion of 11-year notes as part of a debt swap. Bloomberg understands the bond priced with a yield of 9.95%. Kenya has been taking steps to manage its debt maturity profile since its finances came under severe pressure last year. And coming up, we hear from the chairman of Abu Dhabi's Department of Municipalities and Transport on how the emirate is building for the future. More on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. Now, Abu Dhabi is seeing a huge influx of people, but alongside the opportunities comes challenges. Speaking to Bloomberg's Jumana Bersetchi on the first day of the Investopia event, the chairman of the Emirates Department of Municipalities and Transport pointed to public-private collaboration in developing the UAE capital.
This challenge as an opportunity is important for the Department of Municipality and Transport, especially in the connectivity side and the livability side. Our leadership's aspiration in terms of livability is very high, and we have to plan for the future. And as per our urban strategy and sustainable strategy, we have to plan for different type of growth scenarios. And we're hopefully in the next couple of weeks, we're going to launch our new urban plan refresher for Abu Dhabi City. Because as you said it at the beginning, we're seeing a lot of influx of population, which is, we're grateful to have attracted a lot of people that can live, work and thrive in Abu Dhabi, because we have the right components in place and developing an agile plan that can sustain future growth.
And is the plan for that, most of that investment spending to come from the government, or are you expecting private sector participation as well?
Very good question. I think introduction of the private sector in investment of the infrastructure of Abu Dhabi is paramount. And it's not because Abu Dhabi cannot fund it, but I think it goes hand in hand with our economic strategy as well. Introducing public-private partnerships in different models will not only help sustaining the growth of the population, but also going to create economic prosperity. Increasing number of talents in Abu Dhabi, attracting more population, but also letting the private sector take a risk in the infrastructure rather than fully as a government taking the risk. And I think that's hand in hand will definitely make a great opportunity for the private sector to invest in Abu Dhabi.
That was Mohamed Ali Al Shorafa, chairman of Abu Dhabi's Department of Municipalities and Transport, speaking with Bloomberg's Jumoke Oduwole at Investopia in Abu Dhabi. Now, the Trump administration has dismantled Power Africa, a U.S. initiative to increase electricity supply in Africa after more than a decade of work. Almost all of Power Africa's programs have been listed for termination and the majority of its staff fired. For more on this, let's bring in Bloomberg's Matthew Hill, who is in Cape Town with us. So, Matthew, talk to us a bit about Power Africa and what is behind this move and the timing of it.
Thanks very much, Jen. Power Africa was initiated more than a decade ago under the Obama administration and basically targeted to help create an additional 30 gigawatts of electrical energy in Africa, which is the place in the world which has the greatest lack of electricity. We're talking about 600 million people who don't have access. So it was really set up to tackle one of the biggest problems in the world, and now we're seeing it being dismantled.
Well, and Matt, it's still a problem, right? Of course, as you and the team constantly report out. What is the impact that we're looking at, especially if you think about a lot of the rescinding of aid that we're seeing from not just the U.S., but a number of other countries?
Exactly. So already the majority of the big projects, we're told, under Power Africa have been listed for termination. Staff have already been laid off and received their notices. But yeah, that's a very important point. We've also seen, for example, the UK announcing this week that they're cutting back aid in favor of boosting defense spending. So there are some serious worries on the ground here in Africa about how the continent is going to get these 600 million people access to electricity, which is critical for development. It's critical for creating jobs and developing economies.
Yeah, right. Constantly things we're hearing from leaders here on the ground. Bloomberg's Matthew Hill in Cape Town for us. Matthew, thanks so much for joining us and for your reporting. Now, let's take a look at some of the other stories we are following this morning. President Trump says he plans to revoke Chevron's license to operate in Venezuela, threatening to torpedo the nation's slow economic recovery. The U.S. president referred to a concession agreement from 2022, which would match the date that Chevron was granted an oil license in Venezuela, despite sanctions against the government. Under the terms of the license, Chevron would have a 6-month wind-down period to exit operations in the country. Also, Bloomberg has learned that Nissan is drawing up plans to replace its chief executive following another dismal set of earnings and the collapse of talks. To combine with Honda. The carmaker's directors are gauging interest in potential candidates to succeed Makoto Uchida, the company veteran who's been CEO, since late 2019. Now, coming up, the threat of U.S. import tariffs on copper sparks a global race to get the metal to the country. More on what commodity traders are doing next. Stick with us. This is Bloomberg.
The entire drone industry, particularly in the non-red supply chain, is currently under strict regulation in Taiwan. So manufacturing should still be primarily concentrated within Taiwan. Taiwan now can produce 90% of the components in a drone. This means that we will still have issues in the supply chain, and securing components from so-called democratic supply chain comes at a much higher cost, as production is not done on a large scale, but rather through customization. This is the core difficulty we face. Our most critical breakthrough will be figuring out how to open the market and establish organic connections with the global democratic supply chain. This is our main focus moving forward. For example, in the past, an engine manufactured in China might have cost only 10,000 Taiwan dollars. However, if we were to produce the same customized engine in Taiwan, the cost would rise to around 60,000 Taiwan dollars. This stark cost difference is a challenge we must address. The key to reducing manufacturing costs lies in expanding both the supply chain and the market.
Do you think it's ever possible for Taiwan to be able to produce a drone for the same price that you can source from China?
China's drones hold a 70% share of the global market. Taiwan's strengths lie in its abundance of ICT talent.